We are recording.
Hey there, everybody. Welcome to the Thursday night meeting with Scott Forehand, Senior Analyst with Debt Free Life here at Symmetry Financial Group. Welcome. Appreciate your time today to learn more about this very exciting program that Symmetry has come up with. A little bit about the program, just to give you some background. Symmetry started this a little bit more than a year ago, and in the last year, we've helped our families when their plans are fully executed. Those families will have retired, early retired over $750 million in debt. They will save themselves over $250 million in interest, and they will have improved their retirement by over $2 billion. That's as a collective for all the plans that we've put in place. Now, I'd like to say that Scott did all of that, but he did not. He just did most of it. Actually, Scott's last time I counted, he's over 50 families with over 75 individuals. So some families he helped 2 people in the family. Over $35 million in debt eliminated, and over $100 million in additional retirement funds for them to enjoy in a tax-free environment. And without any further ado, Scott, I understand that we have some very special guests on the line with us tonight. Let me go ahead and turn it over to you. And again, I appreciate you investing your time in all of us so we can get better and better and help more families get out of debt.
Thanks, Tom. Yep, my name is Scott Forehand. I'm an agency owner here at Symmetry Financial Group, along with my wife, Donna, my better half, if you will. And we are here today to do our bi-monthly debt-free life introduction / training. And we do have 2 very special guests with us today. We've got Kathy Johnson, Sales Development Manager for Mutual Trust. Hi, Kathy. Welcome to the party. And we've got the, I won't say infamous, but certainly famous, Mark Barnes, Senior Sales Desk Specialist or Sales Development Specialist at Mutual Trust. And certainly if you guys have had any opportunity to work with Mark closely, now you can put a name with a face. And I got to say, Mark, I absolutely love your haircut, and it's fantastic. So welcome to the party, Absolutely. Mark and Kathy. Thanks for coming, guys. So we're just going to go ahead and jump right in. And this is basically going to be our standard debt-free life presentation to start with. We're going to talk about mortgage chunking afterwards, and then we're going to have a Q&A session with our special guests. So let me go ahead and get to that part. We'll go ahead and get this started. And here we go. Everybody see my screen? Welcome to Debt Free Life. So as Tom mentioned, Debt Free Life is a program that was brought to life last year in the May-June timeframe by Symmetry Financial Group. It is a proprietary program, and it is unique in the industry, the way that we do it, the way that we find it, service it, roll it out, the way we plan, and the way we are really getting into the outside the box thinking about how we fund these programs and ultimately what these programs can actually do for you. So first off, if you're on this presentation, welcome. If you're here, you were either invited by me or one of us, one Symmetry agent. So make sure after you finish with this program, when you have questions, if we don't answer them here, make sure you get back with whoever invited you and engage in a debt-free life program if it's appropriate for you. If you're not a client and you're just an agent, welcome. Just an agent. An underwriter broker here, welcome. And hopefully this, maybe you get something out of this, and hopefully you can take away from this and go help some of your family clients. So what is debt-free life? So debt-free life is, in this parlance, is actually a play on words. We're using debt and we're using life insurance to eliminate debt. And we're actually turning debt on its head in the way that we think about debt, the way that we spend money to eliminate debt, and the methodologies that we use to eliminate that debt. So the whole idea here behind using a debt-free life program is that we're going to provide a safe, secure methodology to eliminate that debt, and in the byproduct, it's going to create a tremendous tax-free retirement program that that's going to be outside of IRS control, outside of IRS regulation. You're not going to be put into a position where you're told you can't take it yet, or you have to take it now. You're not going to be penalized if you take it too soon. You're not going to be taxed on it. It's really just the best of both worlds. So that's really what we're trying to do, is we're trying to get you engaged in a different way, a more efficient way to spend your money. So these are two questions we typically ask all of our clients. Are you 100% sure you're going to have a great retirement, or do you have some doubt? I don't know anybody that can answer that question. I'm 100% sure, except for maybe certain pompous financial people that you run into from time to time. And then the last question, and probably even the most important question for most of us, considering most of us have debt, is if we can show you a way to get out of debt in 9 years or less, including your mortgage, without spending any more money than you're already spending, is that something that would interest you? And what I'm finding when I run these programs, and I've run thousands of illustrations at this point, what I'm finding is it's not 9 years or less. The reality is it's 15 to 23 years early is really what's happening here. Because I've seen these programs work in 2 years. But then, for someone who's got $1 million in debt, if I can get them out of 30 years of debt in 12.6 years, is that still something to be interested in? Absolutely. So let's dig down into why this happens the way that it does. And that's because we as Americans are taught a specific way that it's okay to spend money. We're taught that it's okay to take on debt. We are taught that the interest rate that we pay is just part of the process. We are accustomed to paying over a lifetime 40% of all the money we make in taxes. We're accustomed to having that little 1/4 roughly of sliver of your total income to be available for your lifestyle money. And that's the money that you're using to pay for your car payment and put food on the table and pay your power bill and your light bill. And ultimately, if there's any money left over, especially in times of COVID, maybe you pay your Netflix bill, you pay your Hulu bill, right? So the problem that we have here is that we're not spending money efficiently. And that little tiny sliver at the top of that screen, that 3% savings number, that's the real kicker. Because by the time we realize, in many cases, that we don't have enough money for retirement, it's almost too late. So I've seen these programs work. I did one of these on a 73-year-old gentleman, and it works like a charm for him. He's going to be done in 7 years and completely debt-free. House paid off, plenty of money, the whole 9 yards. So it's never too late to start, as long as you're aggressive enough with your program, and as long as you make sure that you get with the person who brought you here, and make sure you follow the plan that gets put together for you. So if these numbers look familiar, 40% of your money being spent on taxes, 34% on interest, and very little for savings, then this means that welcome to the party. You are the average American. And this is me before my wife and I started our program. And this is normal. It's not abnormal. This is what we're taught. And this is what we have to unlearn. So the problem that we have in this country is not that we don't make enough money. We make plenty of money. The average American makes $2 million in their lifetime. That's a lot of money. If you spend it correctly, you don't need any more than that. But the problem that most Americans have is that little number down there, funds of retirement, $60,000. That's that 3% sliver. Most Americans have about $60,000 available to them when they're ready to retire, and they're reliant on Social Security. Is there anybody out there that thinks that Social Security is not going to be insolvent in 2030 unless the federal government does something about it? So if you've all seen the CBO, seen what the CBO says about it, that's exactly what's going to happen. Social Security is going to be bankrupt in 2030 unless they fix it, and the politicians keep kicking the can down the end of the road. So if you're one of those $60,000 at retirement people and you're going to be relying on Social Security, you may want to rethink your plan because the federal government's not going to be there to help out unless something changes drastically. So moving forward, this is where you are when you talk with someone. Let's say you have a lot of debt and you've made the mistake of going to talk to a credit counselor or a debt consolidator, one of those people that say, we'll get you out of debt, we'll fix everything for you. And they're going to call your credit card company and say, hey, we haven't made a payment in 6 months. We know we owe you 3,000. Can we pay you 2,000 and call it even? And in the interim, if they accept that offer, your credit score falls through the floor, right? This is not the way to do this. So some of the more reasonable solutions that you're going to hear are go get a second job, work harder, spend less money, go eat ramen and tuna fish every night, save more, refinance your debt. There's some people out there that teach programs like this that's their big deal. They'll tell you go get a home equity line of credit and use that home equity line of credit to pay down your high interest credit cards. Why in the world would you trade away equity in your home for something that doesn't have any right to equity in your home? So consolidate. The one thing on here that we do agree with, that I agree with, is that debt snowball. And it's as long as you're doing a true debt snowball, not debt stacking, debt snowballing. And there is a significant difference. And we'll talk about that a little bit later. So as we move forward through this presentation, if you do end up having any questions, kind of hold them till the end and maybe type them into the chat window when you get a chance. So doing this, looking at this, the number of times that I've looked at it, and that whole idea of being able to get out of debt in 9 years or less, their better way is something that I'm glad the folks here at Mutual Trust are here. The better way is a participating whole life policy, because that's where we're looking at here. That's the real key here, and some of the additional components of that. So when I look at getting out of debt 9 years or less, how am I going to do it? I'm going to leverage my money. I'm going to make my money spend more efficiently. I'm going to spend my money more efficiently. I'm not going to throw my money away the way that we're taught to do. I'm not going to double up on my mortgage payments just so I can pay down my mortgage fast and have all that money be gone forever. This is where I want to be. So when I'm looking at the current average American with $250,000 in debt, using that standard 3%, 34%, 40%, 23% ratio that we have set, I don't want to be there anymore. I want to be over on the right side of the screen. I want to soup up, increase, rev up, hypersize my retirement. So if you look at those numbers, the debt-free life system, when issued and followed, is going to increase your income, your retirement income, by 500%. That's huge, right? But here's the cool thing. I'm not spending any more money than I'm already spending right now. How? Because we're going to spend money more efficiently. I'm going to reduce the amount of money I'm going to spend in taxes over time by 25%, decreasing it from 40% on the left side to 30% on the right side. I'm going to decrease the amount of money I'm spending on interest over time from 34% to 22%. That little, on the surface of a 12% reduction, that's actually a 35% reduction if you look at the numbers. I'm going to make sure that I've got an increased cash flow. That's my lifestyle. So think of it like this. If you have $1,000 a month left over in your checking account every month and you're on the left side of the screen, what happens if you have what is that number, 10%? 10% increase. So let's say you go from 1,000, it's actually a 40% increase. You go from 1,000 to 1,400. A lot of people can do a lot of things with $400 extra in their account every month. And that's one of the things that this is going to do. This is going to increase cash flow well beyond anything that you can dream of. So moving forward, how do we do it? So we do it by primarily by decreasing the amount of interest you're going to pay and decreasing the amount of taxes you're going to pay. And we do that with a couple different strategies. But the important part of this is we expose your money to compound interest. So where your amortization schedule and your interest with your credit card companies works against you in a compound fashion, we're going to turn that on its head, and we're going to make that work for you in a compound fashion. And we're going to allow you to retire with that income, not like a 401k, where as you're growing your 401k money, you're also growing your tax obligation. We're going to eliminate that tax obligation in the very beginning, and we're going to take it in the end without any kind of tax requirements, tax responsibility. We're going to improve your cash flow. Your cash flow, that's your lifestyle. We're going to improve your lifestyle. So one of the biggest problems with programs that came before us was that all the programs that are out there, there are similar systems like this that have come before us. They've all failed for one reason or another. And there's some critical pieces and some commonalities about why they fail. And that what we're talking about right now, the 80-20 rule, this is the primary reason why most of them fail. And that's because they make some assumptions without planning for the emergency. And so, for example, if your program requires a 12% average gain in the stock market every year, 10 years in a row, it's not going to work, right? So if it's not going to work, then what happens? That means you're going to have that emergency. And if your plan doesn't include an emergency fund, what's going to happen? Your plan's going to fail. The money's going to be gone. It's not going to do anything like what you thought it was going to do. And then ultimately, you're going to be upset with whoever showed you the program. And if you had a friendship with them, it's probably over at best. Okay. So that's one of the key things that we do here. We do plan for that 20% rule. What does that mean? That means the money is available to you. It's hidden. We don't want you to see it. We don't want you to touch it. We don't want you to use it. It's hidden. It's there. If you have a true emergency, not an I need a new jet ski emergency, but a true emergency, like the roof just got blown off and it's going to be 4 months to get my homeowners to pay for my roof. True emergency. You drop a transmission. I need $4,000. That's a true emergency. If you need it, it's there. But we don't want you to touch it. We don't want you to think about it. Out of sight, out of mind, right? So that's the way we work here. That's the part of our system. We plan for the emergency. We prepare for the emergency, but we don't want you to touch it unless it's a true emergency. So, Scott, people ask me all the time, how can this work? How come, why is my 401k not better than this? And this is a simple, very simple computation. And these are real numbers from real performance of a real system. Anytime you have a tax exempt vehicle, that's that tallest column, tax free. If you have a tax exempt vehicle, you're paying the tax on that money up front. It's going into the system is growing, and anytime you pull the money out, you're not paying tax on it. There is no way that you can run an illustration based on market performance, which if you have a 401k, 403b, 457, FERS, KEO, SEP, any of those, if you're going to be in an environment where you're going to have growth, that means you have to have risk. If you have risk, think of it like this. You have a 10% drop in the market. Or there you go, $800 yesterday, right? Whatever percentage that was. In order to make that $800 loss, that let's call it 10% loss, you don't have to come back 10%. You have to come back 12%. And that's just to get to zero. Okay. So our system does not rely on market performance. We are completely insulated from market performance. We don't care if the market goes up, down, or sideways. We're going to have our growth. We're going to lock in our growth every year. We're never going to slide backwards like you are with a 401k or even a Roth, right? We're going to ignore all that. And we're going to have regular, consistent growth that over time, when you couple it with a dividend and you couple it with a snowball, the growth will actually change when you graph it out from what looks originally like a linear performance. It can actually approach a geometric or even an exponential performance once you add the snowball in. Okay. So when you compare these vehicles, this is what you get. A taxed vehicle, tax deferred vehicle like a 401k, can't touch it. When you graph it out, the 401ks cannot perform like this. And this is for all those people that are, financial CFAs, CFPs, Series 663-7, those folks. This is an unfortunate occurrence for them because this is something that really stares them in the face, and this is truth. So moving forward, DFL works in 3 phases. All right. So when people start these programs, they're in the maximization phase. What does that mean? That means we're trying to maximize your initial growth by eliminating your debt in as expeditious a manner as possible. Make no mistake, there is an absolute best way to eliminate your debt. There is an absolute best combination that will get you out of debt the fastest and create the most growth the fastest. There is only one way. Okay. Our system, our software shows us that. Once you get out of debt, you enter what's called the accumulation phase. Or if you're like one of the clients I worked with earlier this week and you don't have any debt, you're starting in the accumulation phase. So what does that mean? That means over time, before we decide when we're going to retire, we're simply growing the solution. We're throwing in money as we need to. we're letting the money compound and do what banks do with our money all the time, which is use it over and over and over again. And then finally, when we get to that point where we're in the distribution phase, that is the only time when she'd be buying that emergency jet ski. That's the only time you should be taking that emergency trip to Tahiti. And that's what the money's for. Distribution. Take it. Enjoy life. Do what you want to do with it. But take it in a tax exempt manner. Okay. So that's the way our system works. 3 phases. Start off with your debt. What we see typically is most of the little debts for people are limited in 2.3 to 2.5 years. And then you're left with just the big debt, which might be your RV, your house, your second house, or maybe your large student loans, whatever. Once you get to that 2.3 year mark, the debt snowball started, it's rolling. You couldn't stop it if you wanted to. And now you're paying down your large debts as quickly as you were paying down your small debts. And then you reach the accumulation phase and you're out of debt. And that's where we all want to be. So, is this new? No, it's not. These are some of the people in the past, or even Warren Buffett still does it to this day. The concept is not new. Mutual trust has been around here for 115 years, and they've been doing this or something similar to this for 115 years. So the concept is not new. Concept does work. It's just previously, in order to do this the way that these folks have done it, you had to have a lot of money to do it. And that's not where we're at for most people these days. So this is something that's available for every man now. And it's something that we're all very lucky that has become available. So Walt Disney did it when he was building Disney World. Ray Kroc did it with McDonald's. And like I said, Warren Buffett still does it to this day. And of course, Doris Christopher did it with Pampered Chef. Nothing new, not a new concept. It's called infinite banking. Nash coined that phrase back in the 60s or 70s. Before that, it was called something else, but it's still the same concept. The idea is that we're putting money into a solution over time that we're able to reuse and recycle that money over time. So we keep talking about this. How do we do it? We're going to redirect inefficiently spent dollars. We're going to grow the cash value in the policy, guaranteed growth rate, plus the dividend over time. Dividend's going to change from year to year. Don't ask me what the dividend's going to be. My crystal ball is broken. You're going to borrow money from these policies over time. There's not going to be any taxation. What do you mean I can borrow money? Yeah, you can borrow money. What do you mean there's no tax? Well, let me ask you this. When you bought your car, did you have to pay tax on the loan that you received to buy your car? Did you have to pay tax on the loan you received to buy your house? The answer is no. There is no tax on a loan. Thank you, federal government. Pay off your debt in 9 years or less. We already talked about that. It's really 15 to 23 years early. Here's the cool thing. Repay loans into your policy with freed up cash flow. That's the debt snowball. So when you're running these plans, the amount of your bank loan capacity is going to go up and down and up and down. It's going to go up when you're adding money to it. It's going to go down when you take a loan. That's the loan capacity. But over time, it's going to get paid back as you're making more premium payments, as your debt snowball comes in, and also ding, 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 as the dividend grows over time. It can actually start to help pay back these loans more rapidly than you had anticipated. Finally, financing future purchases. I'm going to give one example of that in a few minutes. But remember what this is. This is the creation of a private bank that you own, you control, you're the banker, you decide if you're going to lend yourself the money, you decide what interest rate you're going to charge yourself, and you decide on what schedule you're going to pay yourself back, right? That also means if something comes up and you need that emergency, go buy it. If something comes up and it's not really an emergency, but you and your wife or you and your husband haven't taken a trip in 3 years, put it in here. It's okay. Just pay yourself back. Finally, we talk about leaving a legacy. At its core, this is a life insurance policy, and that is legacy. But if you structure these correctly and you do some of the advanced strategies that we can show you, you can actually create not just legacy for your kids or even your grandkids, but you can create generational wealth that your great-great-grandkids will still be experiencing the benefits if you do it correctly. All right. So when we first started doing this original slideshow is old. This is almost a year old. We only had a couple of families that we had some stuff to look at. $84,000 paid off, $73,000 paid off, $100,000 paid off. That's nowhere near the kind of debt that we see with our typical family. I think the smallest debt service I've seen so far for anybody that I've done this with is at least $250,000. And we're using this program to pay that debt off in an expedited manner. So without further ado, let's talk about how you currently spend money. Here's the key difference with why and how debt-free life works versus how your current method of, I'm just going to make extra payments on my credit card and pay it off quickly. So currently, you make your money. Nothing changes there. It's the same as everybody else, same as it is right now. You take that money and you deposit it into your checking account at your Wells Fargo, your USAA, whoever you bank with. It doesn't really matter. And that bank takes your money and they lend it out every night over and over and over again. And they make money with your money over and over and over again. And if it's a good bank, they're going to get something that's going to say, they're going to tell you something like, look, you've got $2,500 on deposit with us. So we're not going to charge you to keep your money in our bank. And oh, by the way, they're still making money with your money every night. Are they paying you anything? If it's a really, really good bank, maybe they're paying you 20.25% on a money market. Maybe. Most likely not. Okay. So the point is they're making money with your money over and over and over again. The average dollar that you put in your bank account gets spent 7 times by that bank. It's lent 7 times by that bank. And they're making anywhere from 1% to 24% with your money, and they're not paying you a dime. So at the end, when you're ready to pay your bill, whatever it is, you tell your bank, pay my debt. And in that process, your money becomes their money, whoever your creditor is. And what's happened? What do you have left over? What do you have left to show for that? Well, your debt is paid. Your money is gone. The bank made money with your money, and they didn't give you any of it. So your net gain is 0. Your net loss is 0. So you're 0. I don't want to be a 0. Okay? So what does that mean? There's a better way. And that's the debt-free life method. So let's look at this. How does that work? Same process. You make money, you work your job, whether it's a salary, hourly, it doesn't really matter. You get your paycheck. The paycheck gets deposited as income into your checking account. And here's where it changes. Instead of us letting that bank sit there and use your money over and over and over again, we're going to make a premium payment. We're going to pay our life insurance premium. That premium is going to come up into your whole life policy. At its core, what debt-free life is, it is a participating whole life policy. Okay? But it's got 2 very special riders on it. And these are those 2 riders. The first rider is a term rider. And I'll explain to you why we do that in just a second. But in essence, you're getting a tremendous amount of life insurance on day one, as soon as the policy goes active, as soon as you make your first payment. But the more important thing of this, if we're doing this for long-term financial success, growth, retirement, elimination of debt, all those reasons why we call this debt-free life, the critical part of this is that paid-up addition rider. Why? Because the paid-up addition rider allows you to buy additional life insurance. Once you pay for that life insurance, it doesn't cost you anything to support it. Once you pay for that life insurance, it's a known commodity. It's a known value. If I buy $1,000 of paid up life insurance today, how much is it worth tomorrow? It's worth $1,000. How much is it worth 10 years from now? It's worth $1,000. How much is it worth 25 or 35 years from now when the big man gives me the big call? It's worth $1,000. The point is, it never loses value as long as I'm alive. Banks know that. That is considered by the banks a tier 1 investment. It is the safest, most secure type of investment. And that's why when you look at Wells Fargo, for example, they have 48% of their assets structured in tier 1 investments, just like this, just like paid up life insurance, That's also why you've seen a large increase in viatical settlement companies who go around trying to buy life insurance policies that have value, paying people pennies on the dollar because it's a great investment. Okay. So backing up, we've made our life insurance premium payment. We've taken the money out of our bank, taken our money out of our bank and moved it up into our DFL bank. And now Our DFL bank is securing our money because we bought paid up life insurance, that the permanent value asset. And now we're making money with our money. How much? Well, depending on who you do this program with, it's typically a 4% guaranteed interest rate plus a dividend at the end of the year. And then sometimes, depending on which company you work with, there's a reason why I love mutual trust. Sometimes they'll give you a monthly compound, and sometimes it'll be an annual compound. And so when you structure these things and you do the math, without a doubt, anytime if you have a 4% total gain per year that's compounded monthly versus one that's compounded annually, the 4% compounded annually is not going to perform as well as a 4% compounded monthly. It can't. It's just, the math doesn't work. So now I've taken my money out of my Wells Fargo account. I've moved it up into my debt-free life bank, which is because I use mutual trust. It is structured at mutual trust. And mutual trust has my money. We've bought the paid up additions. We're paying our whole life and term life premiums. We're keeping the policy funded and keeping it rolling. And now all of a sudden, I've got, let's say we're 10 months in, and I've got $6,000 sitting in my account. And I've got a credit card that I owe $6,000 on. So now I'm going to instruct or request mutual trust to give me a loan. I'm going to take a carrier loan of $6,000 against what I have in my bank, my paid up addition bank. I'm going to deposit that money into my checking account. I'm not writing a check out of my DFL bank and sending it to the carrier or the lender. I'm putting my money from DFL, from, in this case, mutual trust, into my checking account, Wells Fargo. And then I'm telling Wells Fargo, pay my debt. And then Wells Fargo pays my debt, and now the money's gone. It's now their money. But when we contrast this to the previous example, where's my money? My money is still sitting in my DFL bank. My money is still earning a 4% compounded interest monthly. My money is still getting a dividend. I didn't use my money to pay that debt. I used the carrier's money. Thank you, mutual trust. Thank you very much for paying my debt. And then we move on, and now we do our snowball, and now the amount of money we're putting in every month grows and grows and grows. So this is the key difference. So let's assume we're doing this with a home. So let's say you have a $200,000 home, and over time you spend and make your mortgage payments on that $200,000 home, and now your home is finally paid off, and you're using the old method, the one you're currently using right now, and your home is now paid off. What do you have left to show for it? You have $200,000 in equity in your house. What else do you have? That's it. Using this method, a large portion of that $200,000 is still sitting in your DFL bank, earning interest, growing, and you still have $200,000 worth of equity in your house. This is a no-brainer, folks. If you can qualify for it, this is a no-brainer. If you can't qualify for it, I bet there's somebody in your family that can. All right, so moving on. So let's look at an example. So this is a standard family. This is a family I worked with back last October. They're financially in good shape. They make good money, but they have a ton of debt. Okay, ton of debts, plural, lots of debts. Little credit cards, big credit cards, old tax bills they haven't paid, student loans. They've got 2 properties that they own. One's they're a blended family, a mixed family. They were both previously married. Car loans. They got lots of debts, folks. This is not abnormal. When we asked them how much debt they had, that's the number on the left side, $584,000. That's what they thought they owed. And that's truthful as long as they have $585,000 sitting in their checking account that they can write one check and pay it off in one shot. Most of us have our debts financed. So their true debt is $767,000. When they saw that, it shocked them, just like it shocks most of us. That's true debt. That's real debt. It's not just the principal that you owe. It's how much interest are you going to be paying over time. So in this case, they're going to be paying back $182,000 in interest over time. It's a lot of money. If you had an opportunity to keep some of that, would you? Of course you would. So here's what happened. So where they were previously on a 40-year track because of all those student loans, we got them out of debt in 7.8 years. Okay? This is not unusual, folks. This is kind of the norm. We paid off all that debt 7.8 years. Actually, it's faster because these folks are doing chunking. But But this is what we're looking at. And if you look in those columns on the right, that roll up deposit column, that's the debt snowball. So every time we pay off one of those debts, the minimum payment that we were making gets added to whatever our premium payment is every month. That's either going to be buying more PUA, paid up addition, or it's going to be paying back a paid up addition loan. Either way, you're making the money work for you over and over and over and over again. That's the whole concept here. So when I asked this family if they wanted to make the decision, they originally said, because this was a big deal for them. This was a lot of money, because all I did is go through and find everywhere where they were overspending money on a 401k, had a life insurance policy they were spending way too much for, because I think they were paying $400 a month for a $1 million life insurance. But when we executed this plan, they were getting $1.4 million in life insurance. So I don't need to spend that $400 a month anymore. That's one of the places we find money. So when I asked them if they wanted to do this, they said, we got to think about it. And I say, all right, well, think about it. But before you do, let's talk about this. At the end of the run, you're going to have both houses paid off in 40 years. What else are you going to have to pay for it? What else are you going to have to show for it? The answer is nothing. You got equity in 2 houses, and that's it. So when I asked them and showed them if they wanted to do it the second time, I showed them this page. So this is your cost to not do this program down at the bottom, $4.8 million. This program over the 40 years it was going to run, the guy's only 36 years old. Over the 40 years this program was theoretically going to run. In their old program, they were going to run for 40 years and have zero to show for it. And this program, they're going to run for 40 years, not spending any more money than they're spending right now. That's the key here. We're not doing anything. We're just spending money more efficiently. They're going to have 4.8 million liquid in their program. More importantly, they're going to have a huge death benefit that's also already paid up. The total benefit to this family is almost $6 million. So when I asked them the question after I showed them this page, what was your cost not to do this program? $6 million. When you get to that point, the numbers don't lie. This is not magic. It's just math. And the math doesn't lie. This is a contract with the carrier. As long as you follow the plan and execute the program, the plan will work. Deviate, I can't promise you what's going to happen. I have no idea. Moving on. So here's how it worked for them. And there's a couple of key things we want to look at here. Each one of these yellow bars is a year where we're paying off some debt. And in the first year, we're paying off $14,000 of debt. And at the end of that year, after paying off $14,000 of the debt, we still have $12,000 left in the program. The next year, we're paying off another $15,000 of the debt. At the end of that year, we've got $40,000 left in the program. You guys see a trend here? At the end of the third year, we're paying off an additional $58,000 of the debt, and now we're down to $29,000. The next year, the debts that remain are too large to be paid off in one shot. So for the entire next year, all we're doing is growing. That program grew. This is through the effect of compound interest, the snowball, and the dividend. Actually, dividend isn't even illustrated here. We grew $61,000 in liquidity in our program in the fourth year. Next year, paid off another 96,000, and we still have 61 left. The next year, paid off another 68. We got 45,000 left. Next year, not enough to pay off our last home. Got 123,000 left. And the very next year, probably the first month, we pay off $117,000 mortgage, and we're done. And that's the end of the year. So why don't you look at a couple things here? These are a couple critical things. At this point, the debt snowball is being added in. The monthly base premium and all that stuff is being added in. And here is where we hit our first problem. At this point, year 11, this program, because of some IRS regulations, there's too much money in the program. We can't put any more money in the program. It's going to become what's called a modified endowment contract. So in order to avoid that, we have to stash that cash somewhere else. On this particular piece of software and this illustration, that's illustrated at a 2% gain. I have a question for you. If you could start this and get 4% plus a dividend, or put this in a savings account and earn maybe 2%, most likely about 0.5%, why in the world would you start another one of these? There's no limit, folks. So you can do these in a serial fashion. Just keep adding them. There's a maximum amount of life insurance you're going to have at some point, but if you get to that point, you're in great shape. All right. So here's where we go. So this gentleman said he wanted to retire in, where we go? Here at 76 years old. He wanted to retire in 40 years. I said, nah, you don't have to wait that long. So he can retire at age 52. He'll have $1 million in the bank. He can stop making his premium payments, and his plan is still growing at, what is that? $130,000 a year. So what does that mean? That means we've created somewhere north of $100,000 a year tax-free income for him for the rest of his life. Okay. This is not abnormal, folks. This is the way these things work. The effect of compound interest. Einstein said it. There's nothing more powerful in the universe than the effect of compound interest. So let's look at, maybe you're not a family. Maybe you don't own a house. Maybe you don't have a mortgage. So here's a student that I did last October also. This girl, 23 years old, in a master's program, works as a waitress. Got a lot of debt already, up to $91,000 in debt with all those student loans. Student loans are evil, people. They are evil. So what is her true debt? $85,000? Nope, it's $177,000. She owes more interest on those debts than she owes in principal. Isn't that nutty? Okay, so what do? Her program, 9.7 years, completely debt free. Instead of 40, 9.7. This is assuming she never graduates from the master's program, never gets a raise, always works as a waitress, never makes any more money than she's making right now, and just sticks with her basic $350 a month program. So what did it cost her? If she had made the decision not to do this, she'd be 63 years old, she'd have no debt, and she'd have no assets. By doing this at 63 years old, she has no debt, and she's got $600,000 sitting in an account waiting for her. She's got retirement. She's not that $60,000 a year person like their average American. Okay, so that's kind of the end of this basic debt-free life presentation. So what I'd like to do now is I'm going to go into one brief advanced market piece, which is we're going to talk about mortgage chunking, and then we'll be moving on to the next phase of our little presentation here. So let me get the mortgage chunking piece loaded up. Okay. Okay. So this is our little mortgage chunking illustration. So looking at the family that we looked at earlier, same family using the same illustration here. You know, these are all their debts, 40 years of debts with all that student loan and all that stuff. In this scenario, we're going to use their house, their primary residence right here, $215,000. That's how much they owe on their house. Okay. And in our program here, that's the last thing that gets paid off, and they're out of debt in 7.8 years. That's just using the basic program, the basic practice, no mortgage chunking. So what is mortgage chunking and how does it work? Mortgage chunking. Let's see the little kid. So mortgage chunking, we're going to assume a $215,000 mortgage, which is the scenario that we used in this, that we saw for this couple. We're going to assume that the basic debts, the little basic credit cards and all that stuff are paid off in 2.3 years. That's the standard that we see. And we're going to assume that once we get that snowball started, the PUA, the amount of PUA that we're buying every year is going to be about $10,000 additional PUA per year. Okay, so our basic plan's working and we're buying $10,000 in PUA per year. That's $833 snowball per month. That's not hard to get to, folks. When you're looking at most of the people that we deal with, they've got thousands of dollars they're spending on debt service every month. And that's all we're talking about doing, is getting rid of the debt, using that money to grow this plan. So here is where they were. On their first day of mortgage payments, their first mortgage payments was 74.71% interest. That's when they owed $215,000. Pay attention to a couple things. Every time they make their payment, in this case, it was $288 going towards principal and $851 going towards interest, right? So let's assume we're 2.3 years in the future. We've gone ahead and paid down our little debts. We've got the snowball started. we're able to put $10,000 a year extra into our program, which means we're able to take out $10,000 a year. This is 2.3 years in the future. This is where their mortgage is at that point. They owe $203,000. Now they've escalated. $332 is what they're out of every mortgage payment is principal, and $807 is interest. I just pulled $10,000 loan from Mutual Trust, and they did it with a smile. And that money came into my direct deposit into my bank account in about 5 business days. And then I'm going to send that $10,000 directly to my mortgage company. And they are not going to be happy about it because I'm going to pay $10,000 of principal in one shot. And what did I do when I paid $10,000 in principal? There's my $10,000 in principal. I went from 203 to 193. But what did I really do? I jumped 2.4 years into the future with my amortization schedule. So what else did I do? I eliminated every single one of these mortgage payments. So my single $10,000 payment paid $10,000 of principal, eliminated $22,000 of interest, and more importantly, made every single mortgage payment I make from this point forward more efficient. Because where I was paying $332 with each mortgage payment for my principal, I'm now paying $372. That's an 11% increase in efficiency by making one single $10,000 payment that I pulled out of my debt-free life program. So I do it again the next year, and I do it again the next year. So every year, not only am I making 1 year of mortgage payments just regularly, I'm also eliminating about 22, 24, 25 months of additional mortgage payments by escalating myself through the mortgage, through the amortization schedule. That's mortgage chunking, folks. So thank you for listening. Thank you. Hopefully you got something out of it. I know a lot of you have been here before and you've seen the mortgage chunking scenario before, but sometimes it's just nice to hear it again. At this point, I'm looking in the chat window. I don't really see any questions. That makes my job easy. And what I'm going to do is Mark and Kathleen, welcome to the party. So Kathleen, you and I were talking earlier, and you said, I want to see what this mortgage chunking thing's about. So now you've seen mortgage chunking. I'm sure it's nothing new for you guys, but what'd you think?
Well, the first thing that comes to my mind is for those folks that might be paying PMI. If you can get your mortgage down to a point where you're not paying PMI, I mean, that could be hundreds of dollars that you're paying out every month that can be reallocated and reused within the policy and your DFL program.
Hallelujah.
So you're right. I've heard of it before, but it was nice to see the presentation, even if it was a quick one. And,
yep. All right. Well, excellent. All right, Mark, how about you, buddy? How are you feeling about this?
I love it. I love it. I mean, it's something that I think everybody should be doing. I think it's one of the hidden secrets that folks just don't know about. And I love this platform where you've got so many agents and even maybe some clients that are learning this and spreading the word. So it's just phenomenal. I mean, I think one of the biggest things, Scott, that was eye-opening to me with my own mortgage is the true interest you're paying early on in your mortgage versus what ultimately you end up paying 30 years into it. And I think that's a big surprise for a lot of folks who have a mortgage. They just don't realize the true interest they're paying early on.
Yep, absolutely. And while we're on the mortgage stuff, how ways that you can really amp up your program using just your mortgage. Everybody who's got a mortgage, you pay PITI, principal, interest, taxes, insurance. And that taxes and that insurance is being escrowed at your lender. They're using your money over and over and over again. Why? Okay. So all I can say is there's nothing that requires you to pay taxes and insurance into escrow. Don't pay your taxes and insurance into your escrow. Put it up into your debt-free life campaign. Put that money, let that money be part of your snowball. Pull it out when you need it. Let it work for you permanently rather than earning an interest for your lender. They make plenty of money. They don't need any more. Okay. So that's a cool thing. All right. So I am and have been a walking, talking billboard for Mutual Trust ever since I experienced the customer service that Mutual Trust offers. I'm not going to name names, but one of the other two carriers we had, when I had a problem with an illustration, I was referred to go watch a video. And when I had a problem with an illustration with Mutual Trust, I immediately got access, and they said, we'll run it for you. We'll walk you through it. We'll show you whatever you need. There is a huge difference in customer service. And if I'm getting that experience as an agent, broker, underwriter, what's my client going to experience on the back end when they need help or support from the company? So that's a critical piece. So Kathy and Mark, you guys have the best customer service in the industry, and I'm just saying it publicly here. Thank you for what you guys do, because you make my life a lot easier, and I appreciate you. So I see Leah shaking her head. You know what I'm talking about. You've experienced it too. Right. All right. So I got a couple questions I want to ask you guys. So, beyond the just basic, what I've already said about the customer service, we do, and you guys know this, we have options. We've got other companies and other carriers we can place this business with, and there's different reasons why we may, in some minor instances, be forced to use another carrier. But when we're not in that situation, why should we choose Mutual Trust over one of our other carrier options? Kathy, you want to take this to start?
I sure will. And first, I just wanted to quickly just tell you guys thank you for either taking on this approach to sell and spread the word, or maybe as a client thinking about taking those steps to start doing this yourself. As both someone at Mutual Trust working there and also a DFL client, I can tell you I'm very similar to the case study that you showed today with my husband and I, split families, previously married, 2 homes, all of that kind of stuff. And going from literally a 30-year mortgage, because we had just taken it out when we started the program, to being out of debt in less than 9 years with 2 mortgages, college loans for our children, all that kind of stuff. It's amazing. So
awesome.
Just put in for another loan yesterday to pay off yet another debt. So it's one of the best loans you can possibly ask for.
Yep. Awesome.
And with that being said, obviously our customer service is something that we take pride in, because we want to make sure that you understand, we're an A-rated company. We've been around since 1904. But there's been companies that have been around longer that are also really well rated and have insurance products that build cash value. But we are one of the few companies that completely support this selling system and what you guys are all doing for debt-free life. And more so, our support, to be more specific, is not just our sales team, Mark and I and the rest of our colleagues, helping with illustrations and getting plans started, but it's going through the entire process. We've taken the time to make sure our underwriting and our new business teams understand what DFL is. So when you're calling and there's maybe a gray area as to what's going on here, they have the background to understand what it is that you're applying for, why you're applying for it, why there might be a lot of debt in your history, because surprisingly, that is also something that we look at. A lot of debt can affect your lifespan. So another reason why you should be thinking about spreading this to more and more people. But then we go another step forward and we continue on with that training with our in-force policy owner service team. We want to make sure that when you or your clients are calling us and saying, hey, I'm excited, I want to pay off my Visa and I need to take money from my bank, our policy owner, life insurance customer service is not saying, what are you talking about? We're not paying Visa. We're not a bank. It's the translation and the terminology that we understand and can understand that you're saying, I want to take a disbursement, and out of my policy and do this, and maybe offer you even the forms that are required to do an automatic loan repayment to make your life even that much easier. So there's a lot of different aspects to it, but the support, the longevity of our company, the non-veering from whole life participating early cash value products throughout the fads and all the other fancy shiny objects and products that come along, we have stayed true to our whole life products. And that is something that we're excellent in doing because we've been doing it since 1904. So
awesome. Awesome. Thanks. I will, just to piggyback on one thing that you said, the concept of debt-free life in a bank, right? So we're using the word bank in the sense that it's a place to safely and securely put money, to hold money. And that's the extent. This is not something like Kathy was saying. You're not going to get a checkbook. You can't pay your Visa bill out of your debt-free life bank. Okay. It didn't work like that. All right, Mark, you got anything to add to that?
No, it was spot on. I just thank you guys for the consideration and mutual trust. Kathy nailed it.
Okay. All right. Well, Mark, let's go to you on this one then. So a lot of times when I'm presenting this to people, I hear this whole, there's no way that can work. That's too good to be true. What do you mean? I don't have to pay back a loan? Okay. You hear all these things and, in certain cases, no, you don't have to pay back the loan. It can actually pay itself off over time, depending on how your plan is structured, for anybody who asked that question earlier. But the point is I hear it all the time. It sounds too good to be true. And my initial response when I hear that is, well, if it sounded like crap, would you want to hear about it? Right. But from your perspective, because I'm sure you hear this stuff too, when someone says it's too good to be true, what do you say to that? How do you respond to that?
I appreciate that, Scott. And, oftentimes, I usually tell someone that I thought so too, until I experienced it myself, and certainly after running hundreds of these or hundreds of illustrations a week, you certainly see how all this works. The way I really answer this question is, listen, there's a lot of places that you could place, your money. And although DFL is a fairly new concept, high cash value whole life and getting access to that cash value has been around for a long time, as Scott had talked about earlier. The nice thing about that is that when you look at places that you want to place your money or places you may want to invest, oftentimes those places are predicated on the success of the market. Whether that be growth or gains or whether that be losses, oftentimes it's predicated on the market. The great thing about these types of plans, and I think hopefully provides some reassurance to this question, is that there are guarantees involved in whole life. You just don't have those guarantees when your investment vehicle is predicated on the market. That's not the case here with whole life. You've got a guaranteed death benefit, guaranteed cash value. In fact, it's written into the contract. So not only are we telling you, or is your agent and a client perspective telling you that that's how it works, you're going to see that in your policy contract. And so there just aren't too many places that you can put your money or decide to invest, if you will, and be guaranteed a certain return. And oftentimes a better return than you'll find in the marketplace, especially when you consider those losses that may come over time as well.
Right. Well said. You did mention a couple things there. You specifically spoke about the word guarantee and the guarantees that this come with. And you mentioned that having your money in the stock market doesn't come with any guarantees. And I would respectfully disagree with you. I guarantee that if you have your money in the market, whatever you make, eventually you're going to lose. Okay. So that's what I do know, especially if you're trying to play the market. The best traders in the industry are only right 56% of the time. Okay. So, and I was having been a recovering day trader, I can tell you it's an unfortunate day when you lose $50,000 in 2 minutes and then you're out of business. Okay. So so the guarantees that are associated with mutual trust, participating whole life policy here is, they are beyond reproach. They're fantastic. Just again, tipping my hat to you guys. So thanks for that, Mark. And now, Kathy, let's get back to you for this one. So a lot of times when I talk to folks, especially my more financially astute clients, they always ask this question: how safe is my money? How do I know that your company is not going to be solvent? And then when we go down that path, they eventually get to the question, how can the company pay me a dividend, pay me a guaranteed interest rate that's only barely, it's right about what they're paying me right about what I'm paying them. How can they stay in business? Right. So there's I think a misconception about the way the companies make money. And if you could expand on that, how does Mutual Trust able to offer these tremendous programs and still stay in business for 150
so I'm gonna,
years now, right?
Yeah. I think that Mark and I are going to tag team your answer.
Okay.
But the first part, I think the biggest thing on a product side of things is to know that we have one product that is priced and is designed for cash value, early cash value, DFL type sales. We have a plethora of other products for other types of sales, and together they're all priced for the idea of what they're meant for. So the Horizon Value product, which is what we would be using for this type of a sale, it has that actuarial mind behind it, knowing that the money and the cash value that it's going to be earning is going to be loaned out, understanding that with the dividends and everything else that's incorporated in the product, it's designed that way intentionally. And so with that being in mind, we obviously are not going to design a program to make us insolvent or not be able to pay out our claims. That's not going to get us 116 years down the road.
Right.
So as far as the product side goes, I'll answer that, and I'm going to defer to Mark to answer the rest of it.
All right.
Thank you, Kathy. Without sounding too insurance nerdy, if you will.
Go for it, man. We love it. Let's hear it.
As stipulated by law, insurance companies are required to keep a certain amount of liquid reserves on hand to pay claims. So first and foremost, that's within the insurance company. It's not necessarily specific to mutual trust, but we're required by law to keep a certain amount of reserves. Above and beyond that, mutual trust has an incredible actuarial team and investment team that makes sound investments to really help us not only cover operating expenses, but certainly allow you access to your cash value when needed. And it's important to say that when needed. These programs are designed to use for whether it be mortgage chunking or snowballing or certainly paying off those debts. We want you to use your cash value as life demands, whether that be that emergency transmission that Scott had talked about, or it's in fact paying down that $215,000 mortgage. We've made sound investments, and certainly, as Kathy had mentioned, rated our products to make sure that your cash value is there when you need it most.
Awesome. Very, very cool. All right. So I told you guys I would try to keep it. I know you guys have had a long day, been going since like 7 or 8 o'clock this morning. And I appreciate you being here. Is there anything else you guys would like to add? Any questions you guys have? I'm looking down in the chat. Does anybody have any specific questions that we might be able to address? Looks like Taylin's jumping in and answering some of this stuff. We're good there. Okay. So there is a question here that you can probably address. This is in reference to, at some point medical exams are needed. At some point they become fully integrated. At some point they're telemed only. So if you guys could talk about, because I know you guys rolled out that program when COVID started, that we kind of relaxed the full paramedical requirements. Can you talk about that for a second?
Sure, I'll take that one since I deferred the last one to Mark. We make a good team. So yeah, as soon as COVID hit and we had a stay-at-home order in Illinois pretty early in March, which is where the company is based out of, we decided that we realized that the rest of the company was feeling some of the same pains we were, as paramedical organizations weren't open, or people weren't wanting them to come into their homes, even those states or counties that they were open, and started a telemed program for those risks that are under 300,000. In May or June, we increased that to $500,000, and we're currently in talks with our reinsurance to try to increase it even further because the program has been going so well. So long story short, the easy answer is to look at your illustration. The last page of every illustration will say order or don't order labs, or order these things. If it has a list of things to order, that illustration does not qualify for age or risk amount for the telemed program. And if it says not to, then those, of course, are the ones that do at least preliminarily qualify, and we would let you know if anything kicks it out at any point.
Awesome. Mark, you got anything to add on to that one?
Just that we want to make it easy for you, whether you be an agent and you're jumping into these types of programs or these types of designs and concepts, or you're a policy owner. We want to make life easier for you. So sometimes wading through this and customer service can be difficult. As Kathy alluded to earlier, we're certainly well versed in this and want to make it as easy as possible.
Awesome. All right, so this is kind of a selfish question I'm going to ask for me. Because I know that we've got a couple of brand new agents who are just getting their feet wet here with Debt Free Life. So from you guys, from Mutual Trust, from a sales development side, is there any suggestion or any recommendation, someplace, go study this, go look at that, or, give us a call or whatever? Do you have any suggestions for a brand new DFL agent just getting into this, just getting their feet wet?
Absolutely. And Kathy, if you don't mind me jumping in here, first and foremost, maybe a little bit selfish and biased, Scott, but pick up the phone and give us a call. We are more than happy, me or my colleagues, Kathy included, are more than happy to walk you step by step through these illustrations, not only in how to design them, and I think there's some agents on this call that can verify that, we'll confirm that anyway, but not only walk you through how to design your illustration, but also to walk through the illustration itself and sort of decipher what it's telling you. And I think you'll find that that will fuel your conversation with your clients, because oftentimes it's one thing to sell a concept, it's a whole different thing to be able to talk about it and explain it. And I think we're more than happy to do that. In addition to that, if you choose us as your carrier, which we certainly hope you do, Mutual Trust offers a plethora of information on our agent site. So whether it's 1 o'clock in the morning and you can't sleep at night because DFL is just keeping you awake, then you'll have access to recorded webinars and videos and trainings that you can certainly access on your own, despite having someone live like myself or Kathy. But certainly pick up the phone, get a hold of us, or email us any way you can. We're more than happy to help you out.
Awesome. Anything to add, Kathy?
I think Mark, really, this is why I like to defer the questions to him. He hits the nail right on the head each time. But yeah, in addition to that, we have a lot of different flyers and training manuals and stuff that we can help as well. Obviously, it's always easier when someone's there to help walk you through it. But if you're one of those people that would rather try on your own, we've got some stuff there for you as well, too, if you'd like.
Awesome. All right, I got one more plug, and then I'm going to thank you guys. Here's the last plug. To my knowledge, Mutual Trust is the only one with an education reimbursement program, and their program will give you, I think it's $1,000. Is that right, Kathy?
Up to $1,500.
Up to $1,500. So, for example, if you happen to be a debt-free life agent and you're paying for the debt-free life software, is that a qualifying purchase, Kathy?
It sure is.
Okay. And are there any other requirements? I think there's a production requirement to be able to be met as well, isn't there?
So there's two parts. The education reimbursement is something that we do the first quarter of every calendar year. And it's based upon the production you have done with Mutual Trust in the previous calendar year. And it's a tiered program, anywhere from $100 to $1,500 once you qualify. And it does not have the lives app count kind of qualification to it, the same as our secondary reimbursement program, which is within 12 months of you licensing with the DFL software. If you've done up to a minimum of 3 lives or 3 paid applications and 10,000 of what Mutual Trust calls new business credit, or NBC, and on your agent portal, it will keep track of that for you. But once you've hit that 10,000 in your first 12 months of licensing, we will give you back an additional $1,000 as well. So really, there's $2,500 on the table, depending on how much production you do for us.
Fantastic. All right. Well, thank you so much for joining us tonight. I really appreciate the time you've taken, you and Mark. You guys are fantastic. I cannot say enough positive things about Mutual Trust. And if you're an agent out there and you have an opportunity to work with them, give them a shot. You'll understand quickly what I'm talking about. And if you're a client out there and thinking about doing a debt-free life campaign, if you have an opportunity to ask your agent, you may want to look at Mutual Trust as being your potential carrier. So thank you very much. At this point, we're at 6:44. So I don't see any other questions. George Matthews, is that a platform to ask executive bonus versus key person? This is going into a business discussion, and George, I'll take that with you offline. And so, yeah, I think that's it. So get with whoever invited you here, follow up, start your DFL campaign if you haven't already done so. And if you're a new agent, what are you waiting for? Go out and help the family, get them out of debt. All right. Good night, everybody. Thanks for joining us. Have a great night, and we'll be back in 2 weeks.
Thank you,
Bye,
Scott.
Thank you for the
Mark.
opportunity.
Thank you, Kathleen. Y'all take care now.
Thank you.
Tom.
Thank you.
Thank you.
Bye, Scott.
Thanks, Scott.
Bye, guys.
Thanks.